we've got a real problem on our hands, Adam, if the top 10% even gets nervous.
Hey everyone, welcome back to the channel. So today we're diving into a conversation with Danielle DiMartino Booth, and she just dropped one of those stories that every gold investor needs to hear. She's talking about a New York City taxicab driver asking her if gold is going to $15,000, and if you know your market history, you know exactly why that should terrify you. We're seeing century-high volatility in precious metals right now. Silver swinging from 120 down to 108 in 25 minutes. And Danielle's breaking down whether this is the beginning of a massive bull run or if we're watching retail euphoria take over. You're going to want to stick around for the entire breakdown because she gets into defensive positioning strategies, the debt crisis that nobody's talking about, and why the Fed staying on hold might be the worst possible scenario for over-leveraged companies. And before we jump in, drop a comment and let me know where you're watching from. I love seeing this community grow and hearing from all of you around the world. All right, let's get into it.
Interest rate environment.
Okay, so it's a great segue into my next topic. And the day we're recording has been a very volatile day for gold and for silver. And they've had
Actually, the most volatile day in the century. It's
Okay.
in my Bloomberg chat right now.
Really, in a century. Okay. So it's been such a crazy ride. And look, I've been saying at some point there's going to be a pullback because things just don't go vertical forever. But your mom in that generation. So for the past number of decades, there's been what's been called the 60-40 portfolio, 60% equity, 40% bonds, and on an increasing basis now, you're seeing a lot of Wall Street luminaries and Wall Street houses themselves, start to say, well, bonds had a fantastic run over the past 40 years, but we don't think they're going to have a similar run going forward. And for those of you who are looking for sort of ballast to your portfolio here, well, maybe you should take some of that 40% of bonds and put that in gold. And the imbalance of size between the bond market and the precious metals market is pretty tremendous. So if that were indeed to happen, that really should be favorable for the gold price from here. A, do you think that's going to happen? And B, has it started? And if so, what in?
Well, I certainly think that that the side waking up to the shine of precious metals, I find it to be highly poetic and ironic. But B, it certainly would explain fundamental allocations to gold. But by the same token, when oil prices went negative because of margin calls, I don't think anybody thought we were going to stop filling up our cars with gasoline.
Right.
And yet oil prices still went negative. So my biggest concern about the precious metals complex right now is the fact that a New York City taxi cab driver yesterday asked me if he was dropping at Bloomberg. He said, "Oh, are you going on TV?" I said, "Oh, yes." He said, "Oh, is gold going to 15,000?" And that's my concern, Adam.
Okay. So the shoe shine boy redo.
Yes, it is. And you've got people who are logically holding on to gold, like me, like you. We both own gold. We know this. But you also have people who are taking on leverage in order to get into it because it is acting like GameStop on steroids.
Yeah, I know. I'm not so sure how much of it's really being driven by retail at this moment, except maybe, in China. The China retail buying there has apparently just been.
We know silver is dominated right now by retail.
Okay. So, but whatever, like I said earlier, vertical price action doesn't sustain, right? So there's definitely going to be, and we're seeing it today. So just on the morning, we're talking here, Daniel, right before we got on, I woke up, and embarrassed to admit this, but I was tweeting from the bed, and silver had just hit 120. And I said, oh, remember way back when, 5 days ago, when silver hit $100 an ounce for the first time? Well, now it's 20% higher than that. About 25 minutes later, I sent another tweet saying, Remember way back 25 minutes ago when silver was $120 now, it's now 108, right? So, just massive volatility here. And again, that was to be, I think the big on people's mind is, okay, we've seen two really big vertical spikes in gold and silver before. And each time when that spike corrected, it was a massive catastrophic event, down 80+%, and then the metal was dead money for a decade or more. So I think people have been wondering, oh, is that going to happen again this time? Or fundamentally, are there different reasons why, yes, it'll be volatile, there'll be some big pullbacks, but the price will be better supported here because of reason X. Central bank buying, massive investor demand in China, the Western investor waking up to this, capital from bonds moving into gold. So do you have an opinion one way or the other on that?
This is the moment that should send chills down every gold investor's spine. When Danielle mentioned that a New York City taxi cab driver asked her, "Is gold going to 15,000?" That's not just a random anecdote. That's the modern version of the shoe shine boy indicator from 1929. And if you know your market history, you know exactly what that means. Here's what's actually happening right now. We're watching century-high volatility in precious metals. Adam mentioned silver hitting $120, then crashing to $108 in 25 minutes. That's not normal price discovery. That's speculation on steroids. And Danielle nailed it when she said people are taking on leverage to chase this move, treating gold like it's GameStop. But here's the critical distinction everyone needs to understand. There's a massive difference between retail FOMO speculation and structural institutional demand. When Wall Street firms start telling clients to shift from the traditional 60-40 portfolio, 60% stocks, 40% bonds, and put some of that bond allocation into gold, that's a foundational shift. The bond market is $130 trillion. The entire gold market? Maybe $13 trillion. If even 5% of bond money rotates into gold, the mathematics are explosive. Now, Danielle's warning about the taxi driver isn't saying gold is going to crash tomorrow. She's saying when your Uber driver is asking about gold hitting 15,000, you're in euphoria territory. Smart money takes profits in euphoria. They don't buy at the top.
I certainly, I tell you what, I'm not going to answer your question, but I am going to answer your question.
Okay.
So
Answer it, whatever you like.
in the year 2000, I was speaking to somebody who had, let's just say, a 20 million odd dollar position in Cisco Systems.
Okay.
And my suggestion was to, at the very least, remove his cost basis,
Yes.
remove his investment, and just let the profits ride.
Play with house
So
money.
that he could always say, I never lost a penny.
Yeah.
So all I'm saying is, if you feel like maybe century high volatility is problematic, which you should, then maybe you should take a middle position and simply take some profits.
Okay. Well, just so you know, Danielle, I've been pretty vocal in the past weeks on an increasing basis, just encouraging people to consider de-risking, whether that means doing exactly what you said, selling and playing with house money. In my case, I've been personally looking at just hedging. I don't want to, for many reasons, I don't want to sell my ounces, but I don't just want to eat 100% of whatever price correction there might be. But you're nodding as I'm saying this, so we're definitely of like mind there. All right, so we're getting close on time here. Okay, so if I have a sort of generally accurate sense of your view of 2026, you think it's going to be not a super fun year. The economy will probably likely continue to sort of slow down. I think you're that we could really start to see the jobs market start to unwind here. Presumably, whether it's AI or whether it's for some of the other reasons we talked about, I don't get a sense that you're calling for another blockbuster year in the markets, which I keep reminding people would be statistically really aberrant anyways to have 4 years of 20+% returns. So I kind of detect a note of caution from you. Hey, be a little bit cautious going into this year. What type of investment strategies or assets do you think are appropriate to consider for that type of market forecast, if I got your position correct?
So again, being defensively postured and following it never hurts to follow the markets. So becoming more defensive, then become more defensive with markets. A lot of deal activity occurred, whether you're talking about commercial real estate. and in the private realm, we're seeing private investments that are publicly traded. Leveraged loan prices are down at their lowest of the year. So I think there's a disconnect right now. I think if you were to consider a pair trade, if you will, and then apply philosophically, I'd say go
Hmm.
long utilities, go short financials, um, because it looks like losses are finally going to be realized. And in that environment, especially with the Fed on hold,
Hmm.
which is going to keep the bankruptcy cycle going, whether we like it or not. Um, because right now, a lot of companies need zero interest rate policy just to get enough oxygen to take their next breath. But
Right.
we're not going to see that. We one more year yet of too high interest rates, and that's going to have its own implications. So I would just say to be hedged, postured.
The advice Danielle just gave is exactly what separates professionals from amateurs. She told a story about someone with a $20 million position in Cisco during the dot-com bubble. Her advice? Remove your cost basis. Take out your original investment and let the profits ride. That way you can always say, I never lost a penny. And when she said, if century high volatility feels problematic, which it should, then take some profits, she's giving you the blueprint for surviving volatile markets. This isn't about calling the top. This is about risk management when things are moving vertically. Now let's talk about her defensive positioning strategy, because this is where it gets really interesting for 2026. She said, go long utilities, go short financials. That's not a random pair trade. That's a recession hedge. Utilities are defensive, rate stable dividend payers. Financials? They're sitting on a mountain of unrealized losses, and we're about to see that pain materialize. Here's what most people are missing. The Fed is staying on hold. Interest rates aren't coming down fast enough to save over-leveraged companies. Danielle mentioned that a lot of companies right now need zero interest rate policy just to get enough oxygen to take their next breath. Translation? The bankruptcy cycle isn't over, it's accelerating. And when she says we've got one more year of too high interest rates, that's not bearish speculation. That's mathematical reality based on the Fed's current stance. This is why gold becomes the ultimate defensive asset in this environment. It's not about predicting gold hits 10,000 or 15,000. It's about positioning for a world where credit stress intensifies and safe haven demand increases.
And again, if you want to play with house money, do so.
Do so, but you got to take you got to take your original and off the table first to be able to play with the house money. So totally agree
Oh,
with that.
preservation of capital, yes.
Okay. All right. So on your point about the financials, we haven't even talked. There's so much we talked about in the past. It's hard to cram into one interview here, but we've talked a lot in the past about the debt maturity wall, right? Over the past years, about all this corporate debt that's coming up for refinancing, and it was always about survive to 25, right? Which hopefully by that time the Fed will have brought interest rates down, and we'll all be able to refinance again at rates similar to what we took out our loans at. That cavalry has not arrived, as you've said, and the Fed isn't cutting for the time being. How concerned are you about a wave of, if outright bankruptcy is just a lot of compromised debt as companies roll over? And then on the consumer side as well, once all the COVID debt moratoria have been passed, we've seen, especially once the student loans went back in repayment, we've seen an explosion in delinquencies, which are basically just pre-defaults, right? So we've got that working its way through the system too. Yeah.
Yes, and the consumer bankruptcy cycle always lags that of the corporate bankruptcy cycle. But no, just S&P reported just a few days ago that the number of potential downgrades is growing faster than the number of upgrades. So, and distressed debt exchanges are just going gangbusters right now. And that's a polite way of saying we're bankrupt, but we're going to declare bankruptcy. So, no, I do indeed expect, especially given the Fed's stance. I've got my eye on credit. I've got my eye on financials.
Okay. Sure, you saw the same headlines I did. Did you get as nauseated as reading the headline that pretty soon you're going to be able to start paying your rent with buy now, pay later programs?
Oh, Adam, please, do we have to talk about this? Yes. The fastest growing area, buy now, pay later, however, is medical and dental bills.
I mean, I can understand that, I guess, because you're just desperate. You need to have the procedures. But I
Yeah, if your
mean,
kid, if it's got a cavity that they've got to have filled, you've got to do that. And another poppin' area is paying your utilities now, pay later
we might not pay later.
to
Well,
keep
I mean,
plants.
as much of that further nauseates me, it doesn't nauseate not as much as, learning how many people buy their Chipotle burrito with buy now, pay later. I mean,
Or the
the
Mai
totally
Tai.
non-essential, non-necessary. Yeah.
The debt maturity wall discussion here is absolutely critical because this was the survival story for the last few years. Everyone said survive to 25, meaning if companies could just hold on until 2025, the Fed would cut rates and they could refinance at reasonable levels. Well, it's 2026 now, and that cavalry never arrived. Adam and Danielle are discussing corporate debt rolling over at much higher rates, and Danielle drops this bomb. Distressed debt exchanges are going gangbusters right now. And that's a polite way of saying we're bankrupt, but we're not going to declare bankruptcy. Let that sink in. Companies are restructuring debt outside of formal bankruptcy proceedings because the losses are too big to hide anymore. But here's where it gets even darker, the consumer side. When Adam mentions that you'll soon be able to pay your rent with buy now, pay later programs, and Danielle adds that people are paying their utilities with buy now, pay later, we're talking about late-stage credit deterioration. This isn't buying a luxury purse or a vacation on credit. This is people financing basic survival expenses. And the fact that the fastest growing area of buy now, pay later is medical and dental bills, that tells you everything about the financial stress hitting middle America right now. When families are financing their kids' cavity filling with installment plans, the economy is not in a healthy place, regardless of what the headline GDP numbers say. This is the macro environment that historically drives safe haven demand. Gold and silver aren't rallying in a vacuum. They're rallying because credit stress is intensifying. The Fed can't cut rates fast enough, and people are starting to realize the system is more fragile than it appears. Century-high volatility? Yes. Bubble territory? Possibly. But the underlying fundamentals, central bank buying, currency debasement, credit stress, geopolitical tension, those aren't going away. So what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.